I have a very interesting case to share with you today, and this case is about a family whereby the couple is slightly higher income, and I think there are definitely takeaway points because a lot of the questions they're asking may be something that you are also thinking about. That of course includes housing upgrade. I'll touch on it towards the end. So without further ado, let me pull on some case notes to share with you in this very interactive discussion. Now it starts with, not sure if you can provide a third party advice or not. This actually came in through my email. To protect the identity further, I've concealed more information, but this is not financial advice. I don't have full information, I don't have enough information. In any case, I only provide personalized advice on a one-to-one basis on a fee. But what I want to share is thinking points, critical ideas to let you deliberate better on how to improve and approach your own finances, or what are risks to take note of. The couple is age 40 plus. Gross income for husband is 11,500. Gross income for wife is 8,500. That's why the thumbnail 19,000 income. I don't know how to interpret the 2,000 director's fee. So if that is also to be added on, actually their combined income could be 21,000 per month. OA for husband is 40,000 and it's the same for wife. But SA portion, husband has 200k, wife has only 70k. Both their MediSave account is maxed up to the basic healthcare sum, which is $66,000. Just in case you don't know, basic healthcare sum is when you hit 66,000 for 2022, any surplus will go towards your special account, and if it's full, you'll go towards your OA. So this is how our CPF works. You won't see anybody with 200,000 MediSave. So if you haven't heard of it, then it's something to learn. And again, smash the like button early because I think there are pointers that you can benefit from. But I would like to challenge, why is the OA amount the same? And it's actually quite little for anyone in 40s. If you have been working throughout, means 40s, you are easily 20 years in career. Most have several $100,000 already. Maybe it's been used to pay for the house. Maybe they've approached paying the house, which I'll share with you, is a 5-room HDB. They've approached it with a co-sharing equal amount. That's why the OA left is exactly the same. That could be one reason. But then why is the SA so different? Husband has 200,000, wife has only 70,000. So you see, there are questions like this that come up where I can't quite tie in the picture. If it's fully from income, the earnings part for OA and SA, why is the husband's 200,000 whereas the wife is only 70,000? Or could she have invested her SA? In that case, no need to invest SA. SA gives you 4% already. Or is this number inaccurate? No, there are points that I like to challenge because usually there are signs. OA grows at a certain pace, SA grows at a certain pace. So I also have to critique whether this information is accurate or not. But let's assume it's accurate. Both of them enjoy stable bonus about 2 to 3 months. Maybe it's in a government service, I don't know. But 2 to 3 months, if you add on, husband's annual income I've calculated with this gross salary is at least $161,000. Wife's, I don't know, add in business director fee or not, it's about $150,000. So combined income for family, let's put it as $300,000. Now, if you're at a different income level, use this as learning point because they're 40 plus. You could be at a different career stage. So listen and work towards it. Listen and broaden perspective rather than feel any disgruntlement. Oh, how come high income, different income? Don't waste time on that. Spend more time on creating thinking points that can help you build your own finances. Now, let's go on to some details that she's been willing to share with me. They have 2 kids, one in primary school, one in preschool. So, a bit similar to my situation. I have one in primary school, one in preschool. School fees for preschool is $500. From there, I can guess it's with mother's relief and in a PCF preschool. Then kid enrichment is $800. If I compare that to against because only my elder one is going for enrichment classes now, I think that's about fair actually, $800. I'm spending $651, but that's only for one kid. So $800 I think is okay. Parents both sides $1,002. Insurance $1,005. Now if I compare that to my own insurance costs, my insurance cost is $988 per month. I don't know if there are inefficient plans within their portfolio. No? Are there investment-linked plans? Are there unnecessary term plans? Or are there excessively expensive whole life plans? There needs to be something that bumps this up to $1,500 per month because that equates to $18,000 per year. So with a full review, full planning, then these are things we can optimize. Let's move on next to house, food, electricity, and Wi-Fi. $1,000. That is very little. I actually think that could be an underestimate. My gut feeling on things. Because again, there's a helper, correct? Item F. So 2 adults plus helper, 3 adults plus 2 kids, which are even older than mine. I think $1,000 is an underestimate. My gut feeling. Own spending $700 each, pretty prudent, especially considering their income level. Again, spend when need, spend for experiences. Don't need to overstinge. At this income level, $700 each is very prudent. They own a car with petrol insurance cost $1,800. From this, I can guess there's a car loan with it. Maybe I'll pause a bit here. Cars, if you can fully own it. I know COE now is already 100,000, but cars, that car loan portion is very sticky. You prepay early, there's a penalty cost, unlike mortgage. So cars don't take on loan. It's even more expensive than mortgage. And that's why I always advocate, if you need to buy a car, fully pay it. If you can't fully pay it, means you are not comfortable with owning it. So what if it costs 180,000, you need to be ready with that capital, then you buy that. If not, go for a smaller car. If you haven't bought a car, I hope this is thinking points. Because as you progress in career, there's always lifestyle inflation. Once you buy a small car, you see your friend getting a big SUV. Then you want a big SUV. Then you want a Mercedes. These things start to creep in. And that's why I've always seen car being a big anchor to a family's approach towards financial freedom. So I think $1,800 is an underestimate also. Because if I look at my latest bills, petrol cost has gone up quite a bit. I'm spending $850 and mine is already fully paid car. So my guess is this is an underestimate also. Malaysia investment house. Hopefully this can bring in rental income. There's no information on it. In that case, ringgit has dropped badly. Right now you see, right, ringgit is all-time high, $3.30 against Sing dollar. Wow. So I'm not a fan of buying Malaysian investment property. I go Malacca so often, at least 30 times. I'm not kidding you. And I've seen Malacca's property being bidded up to 700-800 ringgit per square foot at its peak, 2018-2019, and then now it's crashed to half already. Not even factoring ringgit depreciation. So Malaysian properties, unless you are very familiar, you have family there, I think avoid, simplify it. It's not true that when you buy overseas properties without ABSD, you're going to make a lot of profits. I'm always concerned about regulatory risk, ability to manage, currency depreciation. Tax payment, $350 for both. My gut feeling on this is it's a oversimplistic rounding figure. Because quite simply, husband at 161,000 estimated annual income at least. If I were to pull up the income tax bracket, you would see that he would easily sit at the 100 to 120,000 dollar chargeable income. If you are new to paying income tax, chargeable income means your total income less way reliefs. So for wife that's working mother child relief, the income tax is very little. 2 kids, right? Husband, usually we have only NS pay and we only have CPF contribution, and SRS, they are contributing to SRS. So only that to remove off, I suspect he's actually paying closer to about 7,000 per year, which is definitely more than 350 per month on average. Could they have used an average? I'm not really sure, because the wife side wouldn't be 350 if there's 2 children on board for her and if she's also making other contributions. Take note again, if you're also a working mother, there's a cap, 80,000 relief limit. So if you're a high income mom with 2 kids, 3 kids, don't need to contribute to RSTU, retirement sub topping up, or SRS already. You have not benefited from tax relief. This suggests that their total monthly expenses is $9,900. I suspect there are underestimates all over the place. I think a better ballpark figure could be about 11,000 per month, which is still pretty okay considering they're earning, like what I mentioned, 19,000 or 21,000. So there is still a 40% savings rate kind of a situation. Still okay. Still very prudent in a lot of ways. So again, when you're listening to here, check back on your personal expenses. Where have you been spending? Look at your savings rate. And you can create a picture of what has happened, which is what I'm going to do in a quick while. And you can project where you'll be in 5 years, in 10 years. Now let's see where they've built up in terms of assets. They're staying in HDB 5-room, balance loan of $170,000. I don't know whether it's HDB loan or bank loan. In any case, if it's not a fixed bank loan, why not pay off the CPF and go and clear off that loan and reduce it even further? So that's my first take. Emergency cash, 170,000. Why is it sitting there? Is it in Singapore Savings Bond at least? Or why not also go and pay down the HDB loan? So these are inefficiencies that straight off I would seriously consider. Then there's also share investment of $70,000. Considering both are higher income And at this phase closer to retirement, I think 70,000 as a feedback at age 40 plus is very, very thin. Why do I say so? Because if you look in terms of this finding by DBS, they've mentioned before, household assets on average, 40% plus is towards property. And then there are other assets, correct? But their picture is very lopsided towards property. That in itself is an over-concentration because there's no guarantee Singapore properties will do well in the next 10, 20, 30 years. Especially when we're facing this part, they first mentioned SRS 50,000 each. For the wife, there's no need to contribute to SRS already. But again, it seems like the details are not accurate because there's no reason to contribute both sides also, when working mother child relief has affected. And in any case, it could also be that husband's income has stepped up this year. So that is another explanation as to why they haven't been contributing that much to SRS across the years. Coming to here, let me critique on some portions because questions are coming up, correct? Is there any opportunity to save on family expenses? I'll take that question. Why not? We flip back to what we see in terms of here. The only thing I'll suggest is Malaysia property. Is there a need to keep it? Could we divest it? Tax, probably an underestimate. Car cost, probably an underestimate. House food, it actually probably an underestimate. They are pretty prudent already. The problem is in maximizing the cash to invest and build financial assets for retirement. So the problem is not really on high expenses, not saving well. The problem is now with this income level and this good savings ratio, how to build financial assets. Because property is not the only way to grow wealth. Which leads to the second question. Shall we sell the HDB and buy private to upgrade? Or take private property as a form of saving investment while staying? And if B is recommended, what is the recommended property price? We check, we can loan up to $2.2 million, which means they can probably take up a property which is $2.8 to $3 million in quantum, assuming they have the capital. Now, you've listened in so far, I guess you have questions on property also. So let me invite you to leave in the comment sections. I have a particular biasness against properties right now in this market cycle. I'll share with you upfront. I'm not bullish on properties. I think we've increased over the last 2 years, 3 years very aggressively, and government is stepping in with cooling measures. In previous episodes, we've touched on government is now cooling the HDB side, and everything is a feedback loop. When you cool HDB, there are fewer upgraders with big budgets to private sector. It cools. Expectations are a loop. It's not like cool HDB, private sector is not affected. I don't think that's true. Everything is loop. Private property, buyers buy HDB, they inflate here. This upgraders inflate that side. It's a loop. Government is curtailing that loop. And I think with higher interest rates, there is going to be a sentiment shift. Let me show you some numbers if you are thinking about this situation. Take note again, they can take a $2.2 million loan. And for simplicity, let me use a case study. What if they buy a $2.8 million property, which means 75% they can loan, correct? Until age of 65. That means the total loan is 2.1 million within their max limit. Can do. Then 700,000 of deposit. If they sell the HDB, if they chuck in all in their CPF and emergency cash and sell away their shares, I think there's a chance they can cough up 700,000. So it's possible that they can buy that, a $2.8 million property, and then take a loan of $2.1 million. Now coming to here, let me show you some numbers as to why very often we've underestimated the difficulty in making profits from property. Because when we sell our property, we think, hey, there's an appreciation, there's a profit level. I buy at 400,000, I sell at 500,000, there's a profit. Not necessarily true. This chart is very useful to explain certain costs. The first I'd like to share with you is this concept of interest costs. In this computation, we put in $2.1 million of loan and then interest rate of 3.1%. 3.1%, is it unreasonable? Not true. I've gotten my recent SIBOR rates from RHB, and that is 3.1 something percent, and it is escalating further even. So 3.1% is not necessarily an exaggeration. If the loan tenure is 20, because to age of 65, correct? What is the monthly payment? Monthly payment is 11,752. So for this situation, for this couple, this is going to be a big bite on your overall. You have almost no more savings already. Be very careful. Of course, you can consider stretching the loan with refinancing and stuff. You can game the system a bit, but the truth is you still need to fully pay off the property at some point in time if you want to stay there long term. That's one. The other thing that's frequently missed out is the cost of taking up a loan. If we were to look 3.1%, the total cost for a $2.1 million loan in 10 years is $524,000. Wow, this is total interest cost over 10 years. If you assume that it does not factor in your P&L, you're not approaching the game correctly. Not just that, you also have buyer's stamp duty. That's assuming they sell away the HDB and upgrade fully to this $2.8 million, 3-bedder, 4-bedder. What that means is that the buyer's stamp duty I've calculated already. For first 1 million is 3% less 5,400. After 1 million is 4%. So the total that buyer's stamp duty is $96,600. With the buyer's stamp duty and the interest factor in, the break-even selling price, drum rolls, let me give it already, $3.42 million in year 2032. You buy a $2.8 million property, 2032 you try to sell it, $3.4 million, you already lose money. You need to sell at $3.42 million and you have not made any money. You have just merely used it as a savings vehicle. Is that very attractive? Is that wealth building? Not necessarily, right? You just put in CPF, it already builds your wealth. So that dispels the question. Is property a good savings vehicle? Depends on market situation and depends on the eventual selling price. Maybe at 2032 it's worth $4 million, then yes, you have made quite some money. But I'd like to highlight that there is a break-even point that it shouldn't be underestimated. Very often we have recency bias. We've seen the properties have appreciated strongly in the last few months. In the last few years, we assume it will perpetually go up. Take note again, DBS has highlighted a few problems. Firstly, DBS has mentioned, this research paper is that properties may no longer be the best asset class moving forward. And it's a public research. I'll try to leave links below if you're curious about it. They mentioned that relying on property alone may not be enough to retire well. Because why? If you over-concentrate on property, your pie is skewed. And if you use it as a homestay, there is no cash flow. Unless you are looking to rent out rooms, that impacts your privacy. Second, changing demographics and overall demand for homes cannot be assumed to be strong because we are facing an aging population. Which means 20 years later, we have less people that can take up loan, correct? It's a possibility. Not that we cannot use immigration to balance things, but there is a risk that home price appreciation might curtail off. Increase in property prices also depends on salary growth. Right now, salary growth is strong on the ground because post-COVID, right, we have a lot of expats not coming out of Singapore. There's a lot of salary growth. I've covered before on this channel in previous discussions. But that salary growth in 2020, 2021 may not be the same moving forward for 2023 if we were to see a recession. And not just that, let me highlight a biggest risk. This is actually a median salary finding by Labour Force. What can we realize from this? Okay, of course, firstly, they are earning above median salary, which is good. I also wish that for you where you're listening in. But the bigger takeaway point is that most of us on average peak out at 40 to 44. Correct, right? This has been consistent across years some more. Which means now you're seeing a pay rise. You are comfortable. Or on the other hand, if you are past 40s, you realize that there's every tendency of salary starting to drop. That's why we hear of PMETs being retrenched and unable to find an equivalent job. It is the reality. It's not going to happen to everybody, that's true. Depends on personal skill set and career development. But if we were to see an average, the peak for income is in 40 to 44. So my question to you listening is, if you were to take up a $2.1 million loan, max loan, at this age segment, and if your income starts to dip in later years, how are you going to comfortably afford it? There is a risk, correct? Will you be forced to downgrade? Again, it depends on property cycle. I've shown you that the property needs to appreciate by a certain percentage just to overcome interest and buyer's stamp duty. So take note again, the concept of using property to store wealth is not correct. You might as well use CPF. For example, her case, she has $70,000 in CPF special account. Why not top it up to $192,000 full retirement sum for this year? It will bring 4% per annum rate. If property is for homestay, then that's a different issue. It's not really for storing wealth. You can comfortably afford it, you upgrade, then that's fine. That's something I wish for everybody. So using this case, let's put our 335 formula to the test. 335 means that you at least have 30% of the initial down payment available on hand. The other 3 stands for 1/3 of monthly income should be used for only property. That's much more prudent than the total debt servicing ratio. And last but not least, 5 times of annual income. So in that case, if you have taken a loan which is $11,000, it's definitely going to breach that 1/3 of monthly income because combined income is $21,000. $11,000 is probably slightly above 50% even. Then what about for $2.8 million property? 5 times of annual income, that will have breached it. That will actually be closer to 9 times of annual income. So coming to here, my suggestion on this situation is to possibly cap the property purchase to $1.5 million and below. If affordability is okay, there's spare cash flow built into CPF, you get a stable stream, buy financial assets, build up a portfolio that can give you dividend income. So these are things that I think will be a much more sensible approach to upgrading and also balancing the act of getting enough for retirement. So hopefully you benefited from this discussion, and as always, leave your questions in the comment sections. Smash a like, smash a subscribe, because I'll be doing podcasts on this channel to share with you financial ideas. And with that, I'd like to do a shout out to an event also that I'm doing. This is the Georgetown Finance Summit. I'd like to touch on properties, I'd like to touch on investments, I'd like to touch on retirement planning, because these are things that I think on a one-to-one basis, if you'd like to meet up, that is an event that I hope to deliver to the masses and help everybody gear up towards financial freedom. With that, I'll sign off from here. Thank you for listening in. As always, I'll see you next one. Goodbye.